Today, my guest is Scott Smith. Scott is the owner of Royal Legal Solutions based in Austin, Texas, where his focus of his legal practice is protecting real estate investors. And he's also the host of the new podcast, Real Estate Nerds, the Real Estate Nerds podcast. And we're going to talk with Scott about that and a whole lot more, including tax-free investing. But first, a quick reminder, if you like the show, please let us know. You can do this by either giving us a like, a comment, share the show with somebody you know, or subscribe. And if you'd like to see how handsome our guests are, you can always check out our YouTube channel, Commercial Real Estate Pro Network on YouTube, and see what it looks like. But with that, I'd like to welcome my guest, Scott Smith. Scott, welcome back to Commercial Real Estate Pro Network, CREPN Radio.
Yeah, Darren, I feel like I was just here, and I got so much to share today about, how can everybody as real estate investors be, channeling their money appropriately to do some tax-free investing. So I think we have a really great show here with everybody today. And I know some of these things, I don't know if you've really got into them too deep before, but feel free to pick apart all of the nitty-gritty details with me here today. I'm an open book for anything you want to know or anything you want to learn.
Well, we'll get into that. Before we do, though, if you could just remind the listeners a little bit about your background.
Yeah, so I've been a real estate investor for over 8 years now. I bought my first piece of property while I was actually in law school. And since that time, I became an attorney, and I was working in high stakes litigation until the point that I found out that everybody that does that actually hates every part of their life. And that's when I switched to doing back to my true love of real estate a little over 4 years ago. And I founded Royal Legal Solutions, which is a one-stop shop for everything, tax, legal, and business for real estate investors anywhere in the country, owning any type of asset. It's really been great over the last 4.5 years because we've accumulated, over 1,000 people that love us and that we work with. Those are the members to the firm. We connect all of our members to each other for deals that they have, or whether they have money and finding deals or have deals and are looking for money. I love connecting people up together, and it's just a great community that, everybody gets to be a part of. It's this little closed circle of serious investors that are actually, making things happen. And so it's really just been great, to be able to create something like that. I think that's been a big change for me. I've never created anything like that before.
No, it sounds awesome. I mean, from a standpoint of, going from something that it sounds like you like the work, but you realize that everybody in it eventually hated the work, to going back to your passion with real estate and, growing a community. It sounds like what you've done based on the ability to connect all of your clients with whether they are looking to invest or their needs or each other. That's awesome.
Yeah, I mean, it's really great. And a lot of it comes, I think, through, people initially get attracted to us because, we have, on the forefront of everything for asset protection of how to, protect and hide assets. I think that's what I speak about most of the time. Today we're going to be talking about some of these tax saving strategies that my elite clients use that everybody could be using, if they knew about it. And so it's really neat because it's like really Royal Legal Solutions is really about saying like, what are the best solutions that are out there that really make sense for real estate investors, not at some theoretical level, but like, this is stuff I've actually walked through. Scott's actually walked through. He's walked hundreds of other people through the same types of things. And here's how they actually work. What you find is that if you build a community that's based around those principles of these are the best ideas that we can find out about that are practical and work, then all of a sudden you have a community of people that aren't really about like talking about fluff stuff. They're not really about trying to hype up everything and just talk about a lot of nonsense. People are really like serious, but in a cool way, like a nerd way of making money. And that's what the Real Estate Nerds podcast is all about. It's all about people nerding out together on what makes sense.
No, I love it. And like I said, I mean, you're passionate about it too, which is, I think, kind of a lot of the fun for myself is if you are passionate about real estate and all its opportunities, it's an easy transition. I mean, the transference of belief and not just a transfer of belief, but then attracting people that are like-minded and having that kind of community there. So that's awesome. Well, I'm excited to talk a little bit today about our topic, tax-free investing. I think that, one of the things, I think when people think tax-free, they start thinking, offshore or illegal stuff, or, things that are not kosher kind of thing. But the reality is real estate has a lot of opportunities that other vehicles don't have. And, the fact that you're an attorney and your whole goal is to keep people out of trouble, who better to talk with about that than you, as opposed to somebody that thinks they know. And I know I've heard multiple strategies from people that I've had to scratch my head and go, I don't know if you can do that, kind of thing. And they only read half the article or the first paragraph or the title of the article, kind of thing. So with that, what, as far as a framework, when we say tax-free investing, how do you describe that to one of your clients on a 30,000-foot view? What does that look like?
Well, we're using the same tools that everybody's using all over the place, right? It's using IRAs and 401ks, and that's not new. I mean, people have been doing that with their jobs all the time, right?
Right.
What we're talking about doing, though, is saying, like, do you have to have your employer and have a W-2 job to do that? And the answer is no. If you have non-W-2 income, any type of non-W-2 income that you have, there's a way to create that so that you can create your own 401k, essentially, or create your own IRA accounts. And in doing so, you're doing the same thing that everybody else that has a W-2 job is doing, but you're just using it with all your non-W-2 income, and just taking advantage of just the really explicit common tactics that you can use for tax avoidance. There's nothing fancy about any of this stuff, right? It's really just kind of one of those things that, like, most people just don't know about. And once they know about, they're like, well, that's a no-brainer. I should be doing that. Right. My answer is yeah, you should be, because it's really simple once you get it up and running, and that's what we're here to do, is we lay the foundations and then you get to run it yourself.
Well, let's talk about that. So you say non-employer income, so non-W-2 income. Does a passive real estate investment qualify?
No, you can't do it with just a passive money directly, right? But what you might decide to do is open up your own property management company, and then your own property management company would then manage your real estate, and then it's no longer passive income; it's active income. You establish that up through like an S corporation to be your property management company. You become the sole employee of that S corporation, and now you're able to start up a solo 401k. So there's some extra legal steps that you have to take to be able to use that strategy. They're fairly inexpensive when you look at what the benefits are to be able to exercise it. And again, these aren't things that you have to set up on your own, right? Like I would always caution everybody to say, you can do things like a DIY, and that's cool. And I can actually explain to you what exactly you would need to do to make that happen. But it's really different from explaining somebody like how to build a car and then actually building one and making sure it's right. Just because, there's little things here and there all over the place.
Can't you use the 3D printer to print your solo 401k? I saw the...
Well, hopefully there's going to be like artificial intelligent robots, and then lawyers won't even need to exist anymore. It's just like a computer that talks back at you. I'm waiting for that day. That'd be a beautiful thing.
Well, don't hold your breath. So let's talk a little bit about that. You said active. Do you need to be a real estate professional, or can you simply be active?
Yeah, just active.
Okay.
It just can't be passive income from real estate. That can't be the classification of the income. But passive income can be converted to active income through the method I just described, and then you could use it for that purpose to establish the solo 401k. The restrictions on the solo 401k are actually really really light. It has to be an entity where you're the sole employee of it, which is fine. That's most that applies to most everybody that has real estate, right? And they were going to do the strategy. They're not trying to hire other employees to be there. So what it allows you to do then is that we'd help you set up that company, we help you set up the solo 401k, and then what you can do is channel up to $50,000 a year of your non-W-2 income into that, S corporation. Then the S corporation pays into your 401k up to that $50,000 mark, and all of the $50,000 is now tax free. You don't have to pay any taxes on it because that's the nature of 401ks.
So you say tax free, though. Are you implying or suggesting that it's a Roth 401k?
Right,
or?
Exactly.
Okay.
Yeah.
Gotcha.
You don't pay, you have, it's all, it's tax free in the sense that it's not that you never ever have to pay taxes on it, but you don't have to pay taxes on it for 40 years or something, right? Until you actually start taking the distributions from it. But the advantages to doing that, investing with pre-tax dollars versus post-tax dollars, and this is where you have to really love to nerd out with numbers on a pad of paper, can typically be like a 20 to 30% bump in what your actual returns are. And just from that one step. Right. So not having to invest in anything riskier or anything like that, you can just automatically get a pretty large bump, on what you're doing. So if it was a 10%, normally a 10% return, your actual returns are 13%. But it gets even better than that, than just saying, okay, you can invest in money. That's kind of cool because you're like, oh, right, great. Well, I'm building a nest egg that I can use for retirement, essentially. But that's not super sexy because for most people, it's, retirement's a long way off, and they're like, okay, well, do I really, care all that much about it? And I would say, well, okay, that's great. But did you know that with the solo 401k that you can actually loan yourself 50% of the value of the 401k? So check this out. You can take $50,000, put it into your solo 401k, all tax free. You loan yourself $25,000 to use for whatever you want personally. Now you owe that money back to your 401k, but you don't have to pay it off until you retire, right? So let's kick that can right down the road. But in the meantime, you just got $25,000 of tax-free money, and you have $25,000 of tax-free money sitting inside of your solo 401k that you can invest in with whatever you want. So you end up being able to live, I think, a lot better. You don't, your alternative would be is to get taxed on all of that 50,000, which would mean, okay, so take out a third, of that number, and you end up with just a little bit more money in your pocket that you can spend for whatever you want, getting taxed on it than you would otherwise. But I'm saying, okay, well, let's live a little bit cheaper by loaning ourselves the money back, and then you get a free $25,000 to go invest in, essentially.
Okay, I want to follow two things you said. So you do have to pay it back upon retirement, or you have to start making payments back? So say you're 50 years old and you put $50,000 in your solo 401k, and presumably, is it easier to figure it as a traditional IRA, or is it easier to figure it as a Roth? Or does it matter?
Yeah, probably. Yeah, it doesn't matter.
Okay.
Not for what you're talking about.
All right. So let's just say it's a Roth. So you've put the $50,000, you've prepaid the tax. In the same year, you could loan yourself back the $25,000.
Yeah, in the same year, you can loan yourself back half of the value of the 401k.
And then when would you have to pay that money back?
At your retirement age. I think it's what is it, 62 now or something like that?
Yeah, I haven't focused on that too much.
No.
So, and is the principal due back then, or is it you've got to start making payments then?
No, the principal is due back then.
Okay. So this is more of a kind of a temporary thing where you can do that. But if you were to have, some other windfalls or something, you could pay that back, I guess is what, you'd have to pay it back from somewhere, whether it be, if next year, instead of making a $50,000 contribution, you make a 25 and pay back the other 25. Is that essentially?
Yeah.
Okay.
Yeah, that's fine, right?
Okay.
You'll owe that money back, and you'll owe the money back to your own retirement account, right? So it's like basically you get to become your own bank with the money that you're pulling in. But the idea here is that like owing money back, like I'm 33 right now, right? But owing money back 30 years from now is not that big of a deal in my mind, because I'm gonna probably anticipate that my wealth curve is going to be on an upward trajectory over the next 30 years, right? So, but having an extra $15,000 today makes a big difference. $15,000, 10 or 20 years from now, almost will probably be inconsequential. Right. And to what it is you're doing, right? So that's the way that I'm thinking about the numbers, is saying that, okay, well, this is one of those situations where you're not like putting money on a credit card where you're accumulating all of this horrible debt associated with it, right? All of the quote unquote debt that you're doing is actually making more money in the short term and then having to pay yourself back later. Right. So it's this very weird type scenario that we aren't usually accustomed to thinking about when it comes into debt allocation.
Okay. And in the investment vehicle presumably would just be whatever stock market option, in that marketplace, or could you then go back and invest it in another real estate parcel? Yeah,
you can invest in real estate. Yeah, it's virtually unrestricted when you can invest with a solo 401k. There are some restrictions to it. So, like always, contact a professional. But of course, those are things that we of course handle for our clients in house about betting whatever deals that they want to get into. But I mean, you can invest in real estate, you can invest in stocks. If you want to JV into other deals that you want to go into, you can have ownership interest in people's companies. If you want to invest in a Panamanian coffee farm, whatever, right?
Yeah.
Like it's whatever triggers your fancy on all of that.
All right. Well, let's talk a little bit about that, because I assume that so far the model we've been talking about has not included holding real estate in the 401k, but more a matter of, as an active real estate investor, you're able to set up the 401k and you can contribute up to $50,000 in that 401k that's not W-2 income, correct?
Yeah, that's right.
Okay.
Yeah, and then you would take that 401k money and invest it in real estate, right? Is that what you're thinking?
Well, and that's what I was trying to understand. So if and let's ask it this way. So I'm an active investor. I've set up my 401k. Now I've come across a deal I want to put in the 401k. So say $1 million, I don't know, small apartment complex. Can you walk us through that? What that would look like?
Yeah, it's super simple. Look, the buyer is the 401k.
Okay.
And that's it. And then you just list the buyers. Yeah. And then the 401k will have its own bank account, and then it transfers the money over to the seller.
So all the income and expenses go through the 401k's checking account.
Yeah.
What about with respects to down payment, percentage, the loan suggesting, assuming you've got to have a loan for the purchase. If you don't have the full 20% down, if you don't have $200,000 in your solo 401k, is there a way to fund the down payment and get the loan in the 401k?
Well, all the loans that you're going to do in the 401k or with IRAs, in this case, all have to be non-recourse loans. So you can't pledge your personal credit to be able to help either one of those entities to be able to go to close on it. But there are non-recourse lenders that are available. And we have a number of relationships with those people to be able to help connect you into what would that financing have to look like. Typically, you're looking at about 20% down on whatever you're going to close into. But there's ways to execute those types of deals.
All right. And what about like the down payment? Like I said, if you've only just opened your solo IRA and you've got $50,000, but you need $200,000 down, are you prohibited from contributing the balance, the $150 deficit, personally, or how can you overcome that?
Yeah, so it's really going to depend on a case-by-case basis. And most of the time what I would consider doing in that situation is just trying to find somebody else that's willing to come into the deal with you that's not a family member. What you don't want to end up doing is doing something where it looks like you're improperly contributing to your 401k. This is one of the reasons why you can't be like a recourse loan against you, because in some ways that's actually you like sponsoring the deal for your own 401k and enriching it more than what you're supposed to have, which at that $50,000 a year benchmark, right? So if you're doing that with your personal funds, of course, that also kind of crosses the line on what you can be doing with that. So I would say that your best bet is going to be to pull in like a third party to help you navigate those waters. And then if it's interesting, it's a very like deal by deal specific analysis of what that particular deal needs to look like. And those are the things that, a professional like myself or a number of other people are going to be able to help navigate everybody through.
Sure. And I just want to follow this just a little bit further, if you will. So if, let's say that I don't have in my 401k enough, but, I'm talking with you, you've got enough, and together we have enough for the down payment, we can get the non-recourse loan. How does that ownership structured then? Because I'm using my 401k and I've got to preserve that 401k. It can't become Scott and Darren's 401k. It's Darren's 401k, and Scott has his money whether it's 401k or not. How is that? Do you go tenants in common in the actual ownership of the property then, or how does that look?
Yeah, that'd be one way to do it. If you were going to do an even split on it. The other way to do it, Darren, would be to set up a LLC that's owned by the two 401ks. And then that would be, and then the money would flow into the LLC from the small apartment complex. The LLC would then distribute the money proportionate to the ownership share of the LLC. And that would be true whether it was two 401ks or if that's 401ks and outside investors or whatever the case may be, just typically of how LLCs work with membership interests like that.
All right. And if the investment is retained in the 401k, then I'm assuming then the proceeds have to be held in the 401k too. You can't just take those. You can't just take the money and say, God, this is all tax free, right?
Right. Yeah. The money belongs to the 401k, right?
Okay.
It's the 401k's money. So remember, you can always loan yourself half of the value of whatever the 401k is from the contributions and the profits of it. So, there's a ways to pull the money out. But right, it doesn't belong to you.
Right. No, right? It's the 401k. So, but theoretically, though, if you did that in a Roth, and in the money from the Roth was had already been taxed, right? So we've got and let's just say that you do have the $200,000 in your Roth, you could then acquire the property in the solo 401k, right? And then whatever income it produced, that would then be tax free. Am I?
Yeah, that would be a way to do it.
Okay,
that's right. Yeah, because then you would have all the money generated from the Roth investment would also be profits that are associated with the Roth, and you actually see a lot of guys doing that type of investment inside of their IRAs. I mean, like guys like Mitt Romney, right, that have IRA accounts that are worth, I don't know, like $40-60 million, something in there. They all have them structured in that way, and they do options trading with their Roths to be able to purchase huge amounts that make huge gains that are, inside of a Roth IRA. But that's a common strategy for avoidance.
Well, and I think that for the average investor, if you look at, your W-2 investing through your employer-sponsored plan, which or at least what I've come to the conclusion of, it's essentially a savings plan because the majority of the money in there is the principal that I've put in there. The interest rate that it's earned over the years is definitely, contributed, but by and large, the bulk of that money is something that I put in there myself from my paycheck. And whereas if you were able to leverage into an investment, if you're able to leverage into a real estate, just the fact that you've got, again, all of the investment principles working, you've got the residents paying down your principal, you've got whatever market appreciation, if you're in multifamily, you can presumably force some appreciation based on repositioning the property. And let me ask you this, because I'm wondering, is there a line of concern that you can't cross? We already talked about you can't contribute to the 401k and have some sort of an inadvertent problem. And is that what they call boot, or there's some sort of a maybe you can tell a little bit about the problem there?
Yeah, well, really, you can run into problems with your 401k in a couple of key areas, right? So one would be like mismanagement of the funds itself. You'll run into a big problem with that. That's actually the one that people run into more often than not, is that they actually don't have accurate accounting records for their company. Like if they did the 401k owned LLC and then they're investing in and out of the LLC, they'll just stop keeping records. Then if that's ever reviewed, you're going to end up in trouble, right? There's also, things that you can't do with your 401k. It doesn't mean you can invest anywhere in the world with any possible asset, right? You're still restricted along what things like legally you're allowed to invest in, right? But you're also restricted among, you want to also start thinking about when you're starting to invest with it of like, are you going to be subject to like the unrelated business income taxes? Which are going to be whether it's kind of associated with saying that if it's an active income with the investment. So real estate's a really good one to invest with the solo 401k because that's going to be passive, and so you don't have to worry about any of these extra taxations, which are 30+% on top of all of the income. So typically that's what I'm looking for, trying to coach real estate investors what to do, which is, here's a way you can take your, passive income, you can channel it into active income and create your solo 401k that you can then turn around to invest in more passive income because that's what you really liked. You already like that type of asset. That's what you're really interested in. Here's a way to get more of that. It's once you start trying to say, well, I'm really interested in new asset classes. Now that's a whole different exploration of like, what do you actually need to be doing for that particular asset class? And then in that particular scenario, we can work with you on what does that need to look like inside of a solo 401k option. But that's a whole new learning curve. So I caution everybody about, taking things very methodically whenever you're going to be approaching new assets, because there's a whole different risk profile that's associated with them, as well as tax profiles and strategies that go with them.
Got it. Let's follow the solo 401k real estate investment just a little bit further here. So we invest in the property. The property's held by the 401k. The rents are coming in. The expenses are going out. The management's getting paid. The mortgage is getting paid. We get to a certain point, 5-10 years down the road, we get some crazy offer. Somebody wants to buy our property for oodles more than what we put into it. How's that gain going to be treated in the 401k?
Yeah, so my understanding is that the gain you're going to have in the 401k is all going to be a tax-free gain. Not having it. It'll be taxed eventually, right? But it's going to be a tax at the end of when you start to pull the money out. You don't actually end up having to pay the gains taxes at the time that the asset's sold. Got it. Because if you think about it, like you'd have to end up paying the taxes out of the 401k itself. Right. So, right. Because if you tried to pay the taxes personally, then all of a sudden that'd be an additional contribution. Right.
No, and then that makes sense because again, as long as all the records are kept, and they're very clear as to, like you said, you haven't mismanaged anything, you've done everything right until the money's pulled out and you've got access to it. That's when the tax would be due, is my understanding. Again, not a tax professional. Consult your local tax professional to make sure you're abiding by the rules. Okay, so the solo 401k thing, I think I get that for the basics. Is a solo 401k essentially a self-directed IRA? No,
they're two totally separate things. A solo 401k is using that system that I just described for you just now, with establishing your own company and a solo 401k underneath that company while you're the sole employee. A self-directed IRA, you're going to typically find those around people that have IRA accounts just generally from their employers. Typically is how people ended up with these. And then what they're doing is you have an IRA. Well, that means, and that has to have a custodian. The custodian then gets to invest that money from your IRA any way they want to. And so a lot of people said, I don't like that. I want to be able to control my money and say where it gets invested. Boom. Well, that's where you have this new thing that got invented that was called a self-directed IRA, which says this custodian holds the money, but then I get to tell the custodian, I want you to go out and purchase 123 Main Street. And then the custodian would then execute the documents and cut the checks and whatever to be able to purchase that piece of property for you that you had found. And now the new breed of investors are looking at it and saying, well, I don't want to have the custodian having to do all the paperwork. One, because they're super slow, and two, because they charge me a ton of fees. So what I'd like to be able to do is move quicker and avoid fees. And so the way you do that is you set up a self-directed IRA with whatever that custodian is going to be. I personally use Kingdom Trust for all of my custodian work. And then what you do is you have that self-directed IRA own an LLC, or if you're in California, you have it own a business trust. So you still have a IRA account. It's still with a custodian. That's called a self-directed custodian. And so now you have a self-directed custodian that's working with your IRA account. That's why we call it a self-directed IRA. The self-directed IRA, that account, will then own an LLC, or it will own a trust. And the reason why you do that is because now you get to control the LLC or the trust that has all of the money from the IRA in it. So now you get to cut the checks yourself, kind of sign the contracts yourself, et cetera, because you're acting on behalf of a business entity that's owned by the IRA. So this gives you all of the control with all of the ownership belonging to the IRA, and then the custodian does nothing and doesn't collect, barely anything in fees because they're not doing anything.
So let me ask you, because I think what you're navigating around is this kind of pitfall that I've heard about the limitations on a self-directed IRA, in that you can't invest or lend money to relatives that so sons, daughters, spouses, or parents is kind of what I understood was kind of the no-nos. But by going through this vehicle and creating the LLC that's owned by the self-directed IRA, are you now able to essentially pierce that problem? I mean, can you go buy your own property?
No.
Okay.
No, you can't do that. Those are all called prohibited transactions, and you're still not allowed to do those. The self-directed IRA with checkbook control, which is using these entities, either an LLC or trust if you're in California, to allow you to control your IRA funds and then manage them yourself, still have to comply with all of the rules, which are things like that, that we helped you with, knowing exactly what those rules are going to be. But the advantage to it is that you can't do anything more that you could do otherwise through your custodian, but you get to do it all yourself. So you get to control the process of it, which is super nice, because you don't have to wait on somebody else to sign closing documents or otherwise make the investment, or to vet investments. I have clients that want to make investments overseas, and then the custodians will be like, well, I don't know anything about this, coffee farm in Panama. I'm not going to allow you to invest in it. And you're like, well, but I want to invest in it. Doesn't matter. So then they go this route. So that way they get to control it, and, we get to vet it inside of our own internal process, which is, what we can do, because we can actually give legal advice where custodians actually can't at all. They're prohibited from doing so. So they can really just tell you yes or no, but they can't actually advise you on anything of the deal. So really the self-directed IRAs with checkbook control are for, investors that typically want to have active management and purchasing the real estate themselves and save on fees, or managing their own brokerage accounts with stocks, or investing in cryptocurrencies. There's all kinds of, people that want to use that as a loophole for control and self-management.
Got it. So just to be clear, make sure I didn't confuse myself, the prohibited transactions are still the related parties, right?
Right.
But
right.
I could still take my self-directed IRA and buy a property for which was an investment for me. Is that correct?
Yeah. So you could buy it. It's going to belong to your IRA, right?
Correct.
So but you're able to do that, and it has the same types of restrictions that you have with 401ks about it needing to be non-recourse loans, et cetera.
Okay.
And you can partner with it, you could manage your own deals to JV into deals with people using IRA funds. The problem with IRAs is that usually they're capped at lower rates, right? So you can only contribute $6,000 or so into it every year. So that's why solo 401ks are so much more advantageous if people are starting, to jump in to do, okay, I'm just going to go ahead and jump straight to a solo 401k. But for a lot of people that have all of these holdover accounts from old employers and have IRAs, this is the way to take those and turn it into something you can actually use.
Got it. So the fork in the road is either your employer 401k, which you can create a self-directed IRA, or if you have a non-W-2 income, then you can then create a solo IRA through that, correct? Or did I say that right? Solo 401k?
So if you have non-W2 income right now, then we can help you create a solo 401k to do tax-free investing there. If you have IRA accounts that are, with your like employer or whatnot, or otherwise have IRA accounts, then what we would help you do is set up a self-directed IRA with checkbook control. So then you could manage those funds yourself and avoid on custodian fees. The idea here being is that like the more power, like I believe anyway, that the more power that we can give to investors to control their own assets and save on fees is the richer everybody gets on that end of it. And my job into that is to, one, facilitate that being able to happen, and two, make sure that people are doing it safely so that they don't get themselves in troubles. And that's why we have this huge education component that comes on with anybody we onboard into the membership of the firm about, here's everything you're going to need to know to be able to manage this yourself correctly, and to help yourself avoid fees means you have to educate yourself.
Got it. Let me ask you just a slight variation. The W-2 employer 401k, what about if you've left a firm and you have a rollover that's not attached to your current employer? Does that still fall in that self-directed IRA?
Okay. That's where you would roll that over.
Gotcha.
You'd roll that over into a self-directed IRA and then start to manage those funds.
Gotcha.
Yeah. You don't want to leave those with the old employer's management. They give you like almost nothing. Right.
No. I've done that, but I was just curious, having the rollover account as opposed to the current employer account. If there was a difference there. So, all right. So, that's essentially what we've covered here is creating a solo 401k or a self-directed IRA, and then investing in real estate through those, creating entities underneath it that are held by the 401k or the self-directed 401k or the solo 401k, and retaining the investments inside that vehicle, the ability to lend yourself up to 50%. Did I say that right? 50% of what the proceeds are? Okay. Yeah. And and all of that essentially is we've been using the word tax free, and I understand what the premise is there, but I think that it's important to note that if you obviously in a Roth you're going to prepay the tax period. It is essentially tax free after the tax has been paid. Whereas the traditional IRA, there is a day when the tax man cometh, and they're going to be looking for you. But the ability to, I would say, what I know about my experience with real estate as opposed to my experience with just contributing to 401k, is that the residual income from the potential sale of the property later on, the gain from that, the escalation of the rents, I guess for tax purposes, maybe we should talk just real briefly about that, because on a typical real estate investment, when you're filing your taxes, you're filing your schedules for the expenses and that. Would that all be just held inside the LLC, inside the 401k then? I mean, you still have to file taxes, right? But there's no tax due because it's held inside the IRA. Am I thinking that through?
Yeah. Okay. That's right. Yeah, that's the right way to think about it. Okay.
So again, the benefits are that you now have, there's the opportunity to get access to that money before retirement tax-free, or I shouldn't say tax-free, but you can use that money prior to. You say tax-free. I'm just going to say, I just want to make sure I'm riding that line there, right? But the access to that money earlier as opposed to later, even though you'll have to pay it back. And again, if you were to do something in the Roth, you would have the ability to grow that essentially tax-free because the tax was paid on the principal, which was the initial investment in there. All right?
Yeah. Yeah. And this is like where it gets really wordy, right? When trying to describe like what are all these different strategies that come up with. I think like as like a takeaway and bottom line it for the end of the episode, what I would say is just like there's There's really cool ways, everybody, that you can take advantage of tax strategies that are much better than you're probably doing right now if you're a real estate investor and if you have any existing retirement accounts. And that, we have awesome resources like either on our website or through us to be able to come get those. But essentially what you want to be looking for at the end of the day, if you do your own research, is look into self-directed IRAs with checkbook controls and also look into solo 401ks and start to look at those options because they're the options that everybody is going with right now. And then however that's going to play out for your personal scenario are things that you would want to consult a professional about to be able to know what's going to make the most sense for you. Got it.
I appreciate you wrapping that up there because I will jump down the rabbit hole on this kind of thing. Now, wait a minute, what about this kind of thing? And
yeah, it's all good.
There's clearly some opportunities to do that. But I think just the understanding of how the two vehicles work and understanding the difference. Honestly, I didn't know and really dug into the difference between the two before. And I know that many of the syndicators that I've worked with in the past, that's kind of their go-to is people that have money in an IRA that they can tap into in a self-directed IRA and invest in a or participate in a syndication. So that's all great. Scott, before we say goodbye, where can the listeners go to find out more about you? And then please remind us about your new podcast.
Yeah, absolutely. So the name of the company where you can get a hold of us is going to be royallegalsolutions.com. You can call us at 512-757-3994, or you can email me at Scott, SCOTT, at royallegalsolutions.com. We have a ton of awesome resources that are on the website. We're also always available by phone. So check it out for the website. It will have like a free ebook giveaway of the top 10 things you need to know to protect your assets. We have a ton of other resources on there about what the topics we talked about today with the self-directed IRA and solo 401k. Huge coming out September 1 is going to be the Real Estate Nerds podcast. I already have over 30 episodes recorded, and we got big names on here. I mean, we got Joe Fairless is coming on the show too, right? So, and we got huge investors they're making their appearances on here, and we're getting into like the nitty gritty of not just the deal. We're getting into the other half of real estate investing that nobody's talking about, which is the person and what they did or didn't do that led to their best and worst deals. So we're getting all of these professionals to actually air all of their dirty laundry of the things that went really wrong in their past. And so we can all learn from their mistakes.
Cool.
So everybody come and join it and check us out on social media and do all that good stuff and leave me tons of reviews and comments.
Yeah, that's the name of the game there is the likes, shares, and comments. So
yeah.
We'll be sure to check that out. And with that, I would like to say, hey, Scott, thanks again for taking the time. I've learned a lot, and I appreciate you kind of making the differentiation between the solo and the self-directed IRA, because I don't know that I'd dug into that as clearly, and I'm sure the listeners will appreciate that as well. And for our listeners, if you like the episode, we'd love to have you subscribe. And you can also leave us a comment and like and share as well. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.